We're looking at a link 4-hour power 1.01 alert. It's a great example of one that officially went down as a loss, but with some basic TA applied, could have easily been turned into a winner. We get the alert at this candle close, so this green candle open. And the first thing that we want to do is understand the alert in the context of the chart. What's actually happening? In this case, we're coming off a significant move down. I mean, I think we can call that a crash, 50% from top to bottom. Even if we had taken it from the break of the range here, 30% move, even in crypto, that's significant. So we know we've had this crash. We get one move up to the EMA 21 in yellow here, pushed right back down. Now perhaps we're putting in a bit of a base here, and perhaps there's an opportunity for a move up. In terms of deciding whether or not to enter immediately, we like to turn to RSI. In this case, RSI itself is just barely out of the bearish control zone. Yes, it's above the EMA, but it's nowhere near 50. It looks weak. And at the same time, we've had one drive of regular bullish div after this big crash. A single drive. It would be unusual to come out of a 50% crash like this and not have at least 2 or 3 drives of bullish div. On the contrary to actually having a bullish div here, we've got potential hidden bearish div. So we're looking at all this and saying, look, there's a potential hidden bearish div on the charts. There's no potential for a regular bullish div. The candle itself is not impressive in any way. Volume is low. It's not like it came up and closed above the EMA 21 here, which would have been different behavior. There's nothing telling us that we need to rush into this entry. So if you decided to take this, where might you enter? Very often, the answer can be as simple as halfway between the price at the time of the alert and the stop loss close below value. So something like this. When you get that better entry, you're able to maintain the RR offered by the TP123 targets by pushing your stop loss down the same distance. Right now, without modifying the entry, if we ape in at the moment of the alert, it's basically a 3.71% stop loss close below value. If we take 3.71% from our new entry, we can get a stop loss close below value down here, below all of the recent areas of interest, all of these wicks that have obviously been acting as some kind of support, outside of this one that knocked out all the over-leveraged longs. So a very simple method is to keep that same buffer zone of 3.71%, but with that new entry, let's just measure it out. 3.71%, 12.65. Well, you get the idea here. Now you've got a stop loss close below value that's below all of this area of interest and provides the same RR at the TP123. There will be cases where you decide to find that better entry and keep the same stop loss close below value. And sometimes that will result in much higher RRs on winning trades. And sometimes, as in this case, it will result in you being knocked out because this candle here closed below our stop loss close below value. Had we not modified it, it officially went down as a loss. Something simple you could have done there is to say, look, show me a close below the recent wick low, which was right here. Let's zoom in. Our recent wick low came in at 12.812. So show me a close below 12.812 and I'll get out. That could have got you a higher RR on TP123. Either way you played it, you had the opportunity here based on the RSI alone to say, I'm going to look for that better entry and to adjust the stop loss based on the new room that you've bought yourself with the lower entry, or based on what's actually happening on the chart in terms of recent wick low. Obviously, an ideal entry here would have been in this recent wick. If you could have grabbed it there, stop loss closed below perhaps this area of interest here, that would be new behavior. If you entered at 12.866 with a stop loss closed below at 12.67, suddenly your TP1 has a much higher RR. That's up to you to decide. That's the beauty of meta signals. Different traders will approach this differently, and you can use it in a way that suits your style and your level of TA. Another way to approach this would have been to say, look, until I see a second drive of bullish div, I'm not interested. So the alert comes and you say, all right, maybe. Show me another drive of regular bullish div and I'll consider it. So where does that come? The potential comes on this pivot point. It would have confirmed on this candle close. So you have your potential regular bullish div, and then it's confirmed on this candle close. Classic stuff here. Then your entry is on the SMA 9. And when you enter there on the SMA 9, you have your current stop loss close below value, which actually kept you in the trade. So obviously there was numerous ways to play this, and how you played it depends on your trading style, your appetite for risk, your TA ability. But there was a trade to be had here, and it required either waiting for a much better entry, which was on the confirmed second drive of regular bullish div, or simply looking for an entry in the stop loss close below zone and pushing that stop loss close below value lower. In terms of the take profit levels, you can see the first level was hit quite quickly. Second level also hit quite quickly. The take profit 3 levels are where oftentimes you can flip to a higher time frame chart to find what's probably going to be key resistance. In this case, if we go to the 24-hour, the SMA 200 is here in white, the EMA 200 is here in purple. You also have a key Fibonacci level here. You can see we've been above the SMA 200 and EMA 200 since September last year. So when you lose both of those, as we did on this candle close actually, April 13th, you're unlikely to just come back up and blow straight through them. So your more conservative take profit 3 level would have been in this area here, where you have the convergence of the EMA 200, SMA 200, Fibonacci level, and in this case the EMA 21 also got tagged thus far. That would have been your conservative exit on TP3, would have given you a solid RR. As it stands, we don't know how it's going to play out. This is basically to be expected that you're going to have people shorting here and exiting longs here, and we'll see what happens next from here. The conservative play was to just get out around the 1550 level, and of course it went, as it often does, to the psychological resistance, which was $16 here.